Hello everyone, this is Yuvraj, working as National Professor in Department of Commerce DM and DM in the Dr. SNS Rajachmi College of Arts and Science. Now, today we are going to see about a credit risk, essential for financial stability. It is a credit risk. So, what is the credit risk in a financial? Today we are going to see about the introduction of credit risk. Credit risk management is critical for maximizing potential loss from borrower defaults. This process involves identifying, assessing, and mitigating risk to protect financial health and ensure regulatory compliance. Understanding core concepts lays the foundation for effective risk control and informed decision making. So, credit risk management is kind of potential losses and borrower defaults. So, that it is an introduction. Fundamentals of credit risk. Fundamentals of credit risk. So, fundamentals of credit risk is definition and importance. So, what is the definition and importance of fundamentals of credit risk? Credit risk refers to possibility for a loss due to borrower failing to repay a loan. It is ritual for maintaining the stability of financial institutions and safeguarding investments. Managing credit risk helps in avoiding defaults and sustaining business operations efficiently. It is the definition and important. What is credit type? So, credit risk includes default risk, counterparty risk, and concentration risk. Default risk is the chance a borrower won't fulfill obligations. Counterparty risk areas in trading relationships, and concentration risk occurs from exposure to a single borrower or sector. Each requires tailored management strategies. These are the types of credit risk. It is a default risk, counterparty risk, and concentration risk. So these are the risk under the, and then traditional risk, trading relationships are the types of credit risk. So next is key risk indicators. So what is key risk indicators? Key risk indicators measures potential credit risk exposure and help in early detection of problems. Common key risk indicators includes non-performing loan ratios, credit utilization rates, and delinquency trends. Monitoring these metrics supports proactive risk management and improves decision making occurs in credit portfolios. These are the risk indicators. Credit risk management process. What are the credit risk management process? Risk identification and assessment. This phase involves identifying borrowers or exposure with potential default risk. Techniques includes credit scoring, financial statement analysis, and market intelligence assessment. Quantifies risk levels using models to evaluate probability of default and loss severity, ensuring well-informed lending dissection. And risk mitigation strategies. What are the strategies we are using? Strategies to reduce credit risk includes collateral requirements, credit derivatives, and loan diversification, establishing credit limits and conventions helps control exposure. These measures minimize potential loss and foster sustainable lending practices. Monitoring and reporting. So continuous monitoring tracks credit exposure, timely payment and deviation from risk policies. Reporting ensures transparency and provided stakeholders with risk insights. Effective reporting frameworks support compliance and enable promotes corrective action when necessary. So it is in monitoring and reporting. Conclusion: effective credit risk management is essential for financial stability and operational success. By applying robotics identification, mitigation, and monitoring process, institutions can minimize loss and enhance portfolio quality. Ongoing vigilance and adaptations are key to navigative evaluating credit environments, evolving credit environments. Thank you.